we will begin now with session 3 of our new course, New Foundations for Auction Market Trading. Welcome everyone. Thank you for showing up. I have a pretty healthy crowd and just had a couple people join. That's good. So we're starting right on time, and I think everybody's here that should be here. We'll do the same thing tonight that we've done the previous 2 nights. I will go for an hour or so, and then we'll take a break. And, we'll do that a couple of times and see where we are. As I have said the previous 2 sessions, this is the initial presentation of this course, and it will be presented again live at some point in the future. Part of the disadvantage for you and for me this time around is that a lot of the material is new, and actually most of the material is new, and I have not presented it in any of the material in this format before, so I don't have a great exact feel for how long things are going to take. But rest assured, if we need more time to cover the things that I want to cover in this course, then we'll just add sessions. I mean, I'm not going to cut it off just because we're in week 6 or week 7 or something like that. As a matter of fact, we're going to cover some things tonight at the beginning that we were unable to cover last time that I want to cover. And I suspect that some of the things that I was going to cover tonight we're going to cover next week. So we're starting to get a little behind in the syllabus as outlined on the website. So fret not if you think I'm missing something or you're going to miss something. You're not. And something else, because this is the first time I've done this, it's an opportunity for you guys when you have seen this and then you've reviewed it. If you have questions about things, if you will send me those questions prior to the next week, I can add the material into the course for the next session, and I think everyone will benefit from that. So there's a huge benefit for you guys seeing this the first time. I can emphasize what you want me to emphasize in case I'm missing something or I'm not being thorough in explaining things. So take advantage of that. Here is the disclaimer about hypothetical results and that trading is risky, which it is. Okay, here's what we're going to cover tonight. We're going to do a review of session 2. We're going to talk about indicators some. We're going to talk about a lot about market condition. We're going to talk about price-based trading. We're going to talk about the 2 phases of market development, the 3-step development process, the balanced area, 2-sided versus 1-sided trade activity, and how to identify and trade balance. And then this is probably going to be carried over until next week. We'll see. So there we go. What are the 2 primary base tenets of auction market trading? I'm asking. I'm going to try and keep you guys awake tonight. This is probably too much of an open-ended question. The purpose of an auction market is to facilitate trade, and value is determined by the trade activity of market participants. These 2, every question you have about the market falls back to these 2 concepts. That the purpose of an auction market is to facilitate trade. So you're constantly asking yourself, is trade being facilitated? And the whole concept is based on a unique definition of value that is extraordinarily robust, it's extraordinarily consistent, it's extraordinarily objective. There's nothing else that I am aware of in any market discipline traditional financial metrics, technical analysis, whatever, that can make this claim. And it's a huge claim, and it's really what makes this work, that we can determine value in a consistent and an objective manner. I had a conversation with one of you this week, and we were discussing the incredible peace of mind that you can get at a time like this when everybody is, I mean, some of the projections that people are coming out with for the stock market now are unbelievable in both directions. So you have all of these people coming out of the woodwork saying that, it's not too late to buy stocks. This thing is getting ready to explode to the upside. And then you have the end of the world people saying that it's going to zero. And, it can be disconcerting if you don't have a basis for your own understanding of the market. And your understanding of the market, there's not a person in this webinar tonight, there's no doubt in my mind that you don't have a better idea and a better basis for what the market is doing now and what will have to happen to change what it's doing now than anybody that you can see, you can watch on CNBC or Bloomberg or anything else. So it's incredibly empowering, this particular view. And it's based on these two tenets: the purpose of the markets to facilitate trade, and values determined by the trade activity of market participants. Trade facilitation, the purpose of an auction market is trade facilitation. That's what markets do. And it also explains why most of the time as traders, until most of us have gone through this period in time where when we were beginning to learn to trade, where we tried all these different things and we'd have a little bit of success, but invariably it would result in just random, some days are winners, some days are losers. Sometimes I have three winners in a row, sometimes three losers in a row, but the net of it is always at the end of any substantial period of time, a loss. And what you're doing when you begin trading is you begin trading noise, because most market activity is noise. So this is the essence of the value and the beauty of how we approach the market. It's defining the market through this value concept and recognizing that most activity is noise, and you want to either already be in the market because you were at an extreme waiting for the next extreme to be reached, or you're out of the market waiting for one of these levels to be reached. The normal state of the market is trade facilitation. The normal state of the market is noise. Noise is an efficient market. Trade is being facilitated. Balance, imbalance. Balance and horizontal development are synonymous. Balance time frames are a specific market condition, and it's that market condition when we can define value. Price is generally in a balance area confined to extremes of a range until the market transitions into the second phase of market development, of which there are two. We'll get into this more later tonight. Imbalance or vertical development. Vertical development is a trend. It's what all traders think that they have to make money. They want a trend, and they want it now. And it's a market that is being dominated by the buyer or the seller. It's an inefficient market. The market is not being efficient in performing its primary purpose, trade facilitation. Value. Now, this is the power in what we're doing. Don Jones's book, Value-Based Power Trading, that's where this concept of value comes from. I want to give attribution where attribution is due. And the concept that the market determines its own value, Don Jones should get the credit for that. And I certainly give him credit for that. And it's an incredibly profound discovery a concept, but at the same time, it's quite simple. It's where most of the people are trading in a given time frame. That's the definition. That's the bottom line. Whether it's a hour time frame, a day time frame, weekly, daily, etc. It's a consensus of a general fairness in price between buyers and sellers, so that the buyers can buy as much as they want and the sellers can sell as much as they want in a given time frame. And that's another key point about value and fair value versus unfair value. Trades occur at the extremes, but you can't trade size at the extremes because it's unfair. You can't get your trade off. Now, market participants are going to determine a small range within the larger range of a given auction of the fairest prices. We call that the high volume node. And it's a key reference area. There are three primary key reference areas, and those three key reference areas are determined when we can identify value, which is when the market is balanced. It's when it's in one of its two states of development, which is balance. Now, there are theories about prices are regressive, and there are entire trading models built from major sophisticated super secret institutions down to the readers of Stocks and Commodities magazines are always trying to figure out these models based on regression of price. What is not understood is that, yeah, price is regressive, but it's regressive around what? Well, it's not regressive around a moving average. It's not regressive around, something artificial. Price is regressive around value in a given time frame. And the reason so many systems traders blow up at all levels, whether it's institutional or individual, is while price is regressive, value changes. So when value changes, obviously, price is not going to be regressive in the same manner that it was. Now, you don't have to have a computer to figure this out. You can watch it and you can see it, and that's what we're doing when we're looking at these high volume nodes. And when you hear me talk at night in the reports about, here's the high volume node, here it's a clear migration of value higher, etc. That's value in that given time frame. It's a very, very important concept. Now, at some point, the concept of value changes, and prices are going to trend, and then you have that trend continues, and then slowly that trend, the trend is a dominance in the market by the buyer or the seller, not both, one or the other, and then typically what usually happens is that slowly, it's imperceptible at first and you're not real sure, the market will become two-sided, there'll be a range established, and a new range of value is found, and the process starts over again. And this is the process that is occurring in all degrees of time in all markets. This is the auction market process. So what are some of the differences between this methodology, trading auction market concepts and principles, and any other? Somebody take a stab at this. This is something, this stuff may seem redundant, it may seem boring, but it's really, really important. I mean, believe me, when you go back over time, if you listen to this webinar, the recording of it, over and over and over, I promise you, you will increasingly appreciate the base concepts here, because it's an understanding of the base concepts that allows you to have the confidence, not to mention the ability to trade the market in the way we trade it. David, absolutely. It's not price-based, it's market condition-based. There are a number of things that are unique about this particular methodology. It's unique in its premise that the market itself provides all the information necessary to provide the information that is needed to develop a trade or investing plan that has a positive expectancy. Now, this is quite a profound claim, and I don't, to the best of my knowledge, there's no other methodology that even claims this. And part of the reason that there's not another methodology that claims this is because this basically depends on knowledge. It doesn't depend on indicators and software and all this other stuff that you typically, the internet entrepreneurs come in and they have to have a business, so they have to have something to sell. Well, they don't really understand the market, so what they're going to do is sell you some magic so that you can understand the market. And they're going to sell you an oscillator, software program, or a money management scheme or something like that. So if you learn this, you will have something of incredible utility that it stands on its own. And I really don't think there's anything else out there that basically stands on its own if you just understand the basic concepts. It's uniquely robust. It's market behavior defined by auction market principles, and it occurs in all markets across all time frames, and this is something else that is quite a profound claim. It dynamically adjusts to all levels of volatility. This is a situation that's been vexing the systems traders and developers forever. As they develop a system, to develop a system, you have to have some sort of testing on back data, and it's extremely difficult to develop a system that's robust across all levels of volatility. Now, most things will fall apart if you have wide swings in volatility like we saw from 2007 to 2008 back to today, where we are once again in a multi-year level of low volatility. But the exact same concepts apply now that are going to apply when we inevitably hit more volatility. They did in 2008, 2009, and they will again. So you are equipping yourself, basically, by learning this to be able to handle any market condition and trade any market in any time frame. What is the highest order use of any graphing format? Yeah, David, determine value. The highest order use is to determine value, to identify where you are at any given time in the auction process.